Okay, very good morning. Let's get the briefing underway then for Thursday, the 19th of January. Just taking a quick look at the charts firstly this morning, and then we'll get underway with some of the overnight news flow. There's been quite a few interesting stories to be aware of, and certainly looking ahead for the session today, a few more events on the calendar than they were yesterday for sure. So at the moment, both pairs have been edging up really since Europe has come into the market. Cables just had a quick look and test before pulling back slightly on that pivot level, 123.24. You can see at the top center of my charts. The dollar is marginally negative, down around 0.1. Did see a little bit of strength around an hour ago. Quite a lot of the press making a bit of a deal about some comments from Janet Yellen yesterday evening, talking about, well, just generally being quite optimistic about the state of play, and they're on track to follow their projected path of interest rate rises. And so people have deemed that to be fairly hawkish, but largely I think that's just a reiteration, which is why that after some minor dollar strength, it's kind of been brushed aside. We'll have a look at that again in a short while. But both pairs slightly elevated, so cable hasn't seen quite the full retracement of that big move that we saw on the day of the weaker dollar on the Trump comment about the greenback with the higher inflation print and the Theresa May Brexit speech. That was obviously the big 8-year best update for cable. We pulled back probably about a third of that move from yesterday, but have found a bit of a floor at 22.63 at the moment, and as I say, it's bounced up through the Asian session up to the open here where we've hit pivot, but still holding on to quite a large portion of that move. But I guess realistically, when you extract that gap lower that we had at the weekend, actually we were trading on Friday about 122.25, and now we're at a 123 handle, so about 75 pips higher. It's probably not as massive a move as it looks on the chart, with that obviously big shift in the markets that we saw just 2 days ago when Theresa May was speaking. Elsewhere though, equities pretty quiet overall. Obviously the usual pickup in volatility around the open and the DAX caused a quick look at pivot, and it's bounced back up net exactly where we were at 8 o'clock, half an hour gone now since that cash open in terms of where the futures are trading. On that note, a statistic that I did see last night, which kind of, we've been talking about, look, really, in terms of picking your battles, that equities are really not the best asset at this present point. That's very true, I think, in terms of the S&P. If you remember the strategies that Vas and I have been issuing over really the recent weeks, if not months, even though we might have short biases from day to day on other assets, for the S&P, we've always kind of maintained along in terms of direction. And I saw this statistic here about it's been a while without a big drop, and this is a measurement on this table of days in a row without a 1% drop in the S&P 500, and we've had 66 days in a row without a 1% drop, and I'm assuming this is the closing price. Again last night, eking out very marginal gains by the close, but 66 and we're still active. Last time that we had 66, you'd have to go back to 2014, and then going back to 1972, 79, and then the kind of mid-1990s. So downside has been limited, but one thing, well, if we take this another step here, another stat for you is that for 3 straight days, the S&P intraday range of less than 0.5%, and since 1970, this has never happened before in the month of January. So I think that when we have the inauguration of Donald Trump, obviously that's coming up on Friday. I think once that passes and he is into place, obviously then it's official. Then he's in, and then what he says is really going to count, so to speak. And although you've probably seen press articles like this morning, there was an interview or a comment that Trump made last night. Donald Trump claims in an interview he does not like using Twitter. You wouldn't have thought that, because I did a quick tally up of the maths this morning. He does roughly 6.5 tweets since the beginning of the year per day. If you extrapolate that out till year end, because he said that when he becomes president, he will continue tweeting because it's the only way, he says, to negate the made-up press allegations. Now, if you take that across from tweets that we're expected to see then on this kind of pace, we're looking at roughly 2,409 tweets from Trump to come. And if you actually look back and do a measure of the last 19 days of 2017, I would say that actually probably about 50% of those tweets have caused a move in the market. Whether the Mexican peso, Ford Motor, Toyota shares, definitely they are not to be dismissed, because I don't think even he himself has quite worked out the power that he has, just given the comment that he made so explicitly about the dollar as well just the other day. So certainly those Trump tweets I don't see stopping, and my point being that although we've been in an extremely tight historical range for a considerable period of time, I think once Trump is inaugurated and comes in, then actually he can start that first 100 days when he starts outlining in more detail about the fiscal policies and so on and so forth. Things hopefully will start to liven up for that particular asset. But a good lesson in actually the better action has been elsewhere. And FX, for one, I would say is probably the first and foremost, and probably will remain the same for this week. The other headline then that briefly spoke about just a few minutes ago was Janet Yellen. So the headline reading that Yellen says the economy is near goals and warrants gradual rate hikes. I and most of my colleagues are expecting a few hikes a year. Fed chair says the timing of next rate increase depends on the economy. So I can see how you might get a bit excited about the comment about her and her colleagues expecting a few hikes a year, but actually when you take into account the summary of economic projections, this is exactly just reaffirming the current Fed trajectory of rate increases of 3 for 2017 and then increasing thereafter in the accompanying years. So I think just the fact that it's come from Yellen, we've heard from a number of Fed speakers since the beginning of the year, but it's the first time you've really heard from the Fed chair herself. And so it may have drawn a little bit of attention, but I think overall people have largely brushed this aside. But maybe worth contemplating when the US come back in, because this did come out fairly late in the US session yesterday. Obviously, the big thing that people will be looking at today is the ECB. We've got it's almost snuck up on us, and absolutely no one is talking about it. Just given such a focus on the Brexit situation this week and kind of European politics, no one's really talking about the ECB. Now, the chart that I'm showing to you kind of explains the reason why that is. So this is a graphic here about when will the ECB act again. And if you're going off the Bloomberg survey economists, so this is broadly when they survey about 50 different bank economists. They conducted this last week, and the majority do not see any new ECB policy action until the September meeting or later. Now, this comes obviously only around 6 weeks since we saw the ECB take quite significant policy turn, reducing the amount of monthly purchases to 60 from 80 billion, making some parameter tweaks as well about the way that they purchase these bonds. And so we're not expecting any change now for the foreseeable months. The end date on the program, although it's somewhat open-ended, is now the end of this year. And so it makes sense that September meeting is really key, because then that gives them a few months lead-in towards any potential changes that might need to occur from the defined end date, which is December of 2017. Also, of course, by September, we will know how the land lies with a bit more detail on the political spectrum, from certainly the French election situation, and also how the Brexit negotiations are going, but also the German federal elections as well, happening at around that time of the year. So that's the reasoning there, and why today's ECB meeting is really, I I wouldn't say a non-event. It will cause some intraday volatility and will likely provide an opportunity to trade the euro currency later, particularly over the press conference, because there are certainly a couple of things to be aware of particular interest. So this article was sent out to you by Vass earlier this morning. Please do take a read in advance. No excuses. You've got to be well prepared in order to kind of effectively navigate a press conference. Is all about knowing what are the key topics and what is it that the market's priced for these particular subject areas to then trade accordingly. So the QE terms, I think, is probably going to be some extent to a slightly lesser degree now that we've seen that change, as we said, in terms of the purchase size requirements. But this one's probably one of the more important ones, is in the subject of inflation. Because as you've seen, between November and December, annual inflation in the Eurozone has shot up from 0.6 to 1.1%. And if you're looking at Germany specifically, which is often seen as kind of the engine room of European growth, then the shift was even more dramatic. Prices rose 1.7% in the year to December in Germany specifically. And so it's these metrics which they'll be watching very closely. Now, a lot of this can probably be discounted towards a bit of a pop in oil prices, so the energy component lifting the prices overall. But it's definitely something which the Germans, given that their situation is almost more acute on the inflation side, means that they're very probably going to be even more usual hawkish rhetoric, more anti any further extensions to QE and so on and so forth. The other thing, of course, is Italian banks. Had a question actually yesterday about I can't find a price for Monte dei Paschi, and actually they haven't traded. So the reason why you've probably not heard Monte dei Paschi shares being mentioned on the mic on the Squawk for the last 19 days is because they have not opened for trade. They are currently suspended. The fact that they're still trying to iron out this recapitalization plan, they're still going through restructuring and so on and so forth from the Italian government, working with their ECB and European partners. Actually, they've suspended those shares for the time being. But Italian banks, although it's moved, I would say, to the back of the queue in terms of major macro fundamental drivers of the market, it's still definitely an ongoing situation that does require at least a bit of monitoring. Elsewhere, the subject of the US, definitely the timing. This ECB meeting comes because don't forget that we have the Draghi press conference as usual. This will have the Q&A session that goes on for about an hour. And no doubt he'll be asked about the upcoming inauguration of Donald Trump and what that means for Europe and ECB policy, if anything at all. We heard only at the beginning of the week about Donald Trump pledging to slap a 35% tariff on BMW if it exports from plants in Mexico to the US. This is obviously going to have implications for, if this goes through, the German economy, given largely export names that are involved within the makeup of the constituents of that index. So certainly this could be something for consideration and spoken about from Draghi today. And then the last kind of big point and subject matter will probably surround Brexit, the big implication of the UK's intention to quit the single market is on the clearing of payments denominated in euros, and much of that takes place in London. So of course, this is going to be something which I'm sure, given the context of Theresa May's pretty stern, direct delivery about wanting her cake and eating it, but whether or not Europe will adhere to the kind of demands that she's outlaid, we discussed that yesterday. I doubt it, not to the amount on which she's specified, but it'll be interesting to see whether or not the ECB get involved. The one thing to keep in mind is that Draghi and the ECB usually are very reluctant to get involved in the politics side of it. They like to very much distinguish that they are different, even though that we know that politics is a very powerful force at the moment to guide monetary policy. But I would imagine he'd be fairly tight-lipped on that situation. Okay, other things that I've been looking at are OPEC. Now, you probably heard these comments yesterday by Barkindo, who said the OPEC chief, so this is the Secretary General, I was explaining to a couple of the guys in the early stages of the program that the makeup of OPEC is essentially all the different nations. You can essentially put them in a hierarchy of the most influential or by the production value that they have. But the mouthpiece of OPEC is the Secretary General, or the chief, as you're seeing quoted here in Bloomberg. So when he speaks, it is important. And he said that so far, so good on the deal to cut production. And this has been a real point that I think, from a communication tactic point of view, OPEC members have been very vocal about, yes, we've done it, we've met our quota, we're actually doing more. And they keep saying that again and again and again. So why do they keep doing that? Well, if we look at this chart here, it'll probably make a little bit more sense. So this is going back actually, over 10 years actually, back to 2005. And what you can see here is the blue line is the OPEC quota over that period of time. You can see various changes that occur, obviously to act various peaks and troughs of how the economy is performing and supply situation, so on and so forth. The point being here is that the white line defines OPEC production. Now, OPEC, or in essence, these two lines should hypothetically converge, and they should be very tight around, if there's a quota, that's what you pump, no more, no less. But what you can see here is that the white line sits above the blue line probably 95% of the time. So when we talk about the fact that, do we really believe OPEC can strike a deal and stick to the quotas? This is why we were so apprehensive going into that November meeting in Vienna, and the reason why the market rallied so much was because OPEC has such a bad track record, as defined by this graphic, at sticking to it. Now, the interesting thing is that so far they've been trying to really ram home the point that it is getting done, and to give them their fair dues, they are following that through for one of the first times that certainly I can remember. So this commentary, I think, is about a strategy to reassure markets, which is why you're kind of having this kind of vocalness about these headlines that you're hearing. Obviously, with oil, you had the Martin Luther King Jr. Day on Monday, which meant that markets in the US were closed. So we had the API inventories last night. Well, first of all, let's just have a quick look at the chart at 9:30. Let me just highlight the specific section on my chart when that came out. You can see there the more extension of the wicks. But ultimately, even on this 1 hour candlestick, we pretty much opened and closed at the same level, despite the whipsaw price action. So why did we see a bit of an exaggerated move? Well, a quick look at the numbers. We had an exceptionally large drawdown, 5 million. Expectations were for a drawdown of just 1. And then Cushing was a draw, bigger than expected. And that seemingly then was countered by gasoline, which had a build of 9.75 million. I would imagine probably what would have happened here was that, looking at the way the charts are set, you would have spiked higher, initial knee-jerk reaction to the much bigger draw in the headline crude figure. Then it would have come down on the gasoline number, and then gradually just rose slowly during the overnight session, just in the context that the crude and Cushing together may have a slight outweighing bias against the gasoline figure. But overall, that's what you're going to be looking for when obviously the DOE numbers hit, which will be later today. Don't forget, with the Department of Energy numbers, they're normally at 3:30 on a regular basis, but always when there's a bank holiday and they get delayed by a day, as is the case this week, they'll come out at the later time of 4 p.m. for those crude oil numbers. Okay, last kind of story to have a quick look at, let me just bring it up, is this one. You may have read already. Marine Le Pen establishes a lead in first round of French election polls. So presidential favourite Francois Fillon still expected to beat the far-right leader by a comfortable margin though in the second round. But latest polls have Le Pen in the lead for the first round. Now, don't forget that in France there's a slightly different format that is followed during this process. And it's about, I think, the elimination of candidates. Then they have a final runoff to then get a majority in the end in the second round vote, of which Fillon is still heavily favoured to win. I did see some interesting comments here, and I'll give my take as well. So the National Front leader is now polling 26.5%, which is a lead of 1.5% over the former PM Fillon. However, Fillon is expected to beat the far-right lead in the second round runoff in May, with polls giving him at 64% over Le Pen's 36%. So he's heavily ahead in terms of the final and more critical second round. Now, let me just scan down here. There was some interesting comments. So 2 polls showing Marine Le Pen in the lead mean it is looking a little more likely she will do well, but the main thing to consider is the public still know her much better than her likely 2 competitors. In particular, they don't know who party socialite competitor will be at all. So generally, she's just been getting more and more press coverage, but as the runoff goes on, others will become more apparent to the voting public. The other thing here to be aware of as well is that given there's a 2-tiered format for the French system, just imagine if the EU referendum we had at the time, back in the summer of 2016 in the UK, if we had a secondary referendum vote the week after. Now, probably, given the fact that no one was expecting that to occur, even though there was, at that point, obviously there was an initial shock, knee-jerk reaction lower in the pound, which did continue to sell off in that week after. Probably if he held another referendum, maybe the Remain might have come back, because the people who voted for Brexit, who only did that because they thought Remain was a shoo-in, maybe they would have come back and then voted for Remain. Now, I do think if we had another referendum today, we would still vote to leave as a country. But giving those timings on that basis, you would have made your point with the protest vote, and then actually reality sinks in and you vote with the continuity. So this is what often a lot of the view is with the French situation, that will safeguard France from this against a populist win or a far-right national party such as Le Pen, is that yes, you can make a point, she can win the first round, but ultimately she has to win both. And when it comes to the second round, people have made their point. The second round then is about voting with economic and social sense, I guess. So that's kind of how that's going to play out. Again, even though I would say Fillon is heavily favoured to win, that does not mean he's going to win. Obviously, the market very much more cautious now about discounting the underdog, which Le Pen is in this situation. So this is going to get interesting. This is just another road hump that the markets are going to have to tackle. It's kind of, again, there's so much other things going on at this present point in time. First and foremost, Trump, then probably layered under that Brexit. This will become more of an issue, I think, as we get towards April, May time. Okay, looking at the schedule for today, a couple things to be aware of then. You've got the EIA monthly report coming out next couple of minutes actually, so keep an eye on that. It's not going to be, and it never is really a quick release. Oil moves straight away, but certainly for an update on the supply and demand situation, it will be something to keep an eye on. You've got the ECB then, usual format, 12:45 for the rate decision. Remember, absolutely no one's expecting anything to happen at the rate decision. The 12:45 announcement is a complete non-event. It's the press conference that you guys need to be plugged into, and that of course will start at 1:30 and probably last for about an hour. In the afternoon, from a US point of view, you've got building permits, housing starts, fully fed manufacturing, the weekly jobless data, and the oil inventory numbers. So today should be a bit more of a lively affair. You do also have Donald Trump, his team, they're speaking at 2:15. Very important to note though that the president-elect himself is not speaking. This is just his team that will be delivering an update with the press. Normal kind of Q&A session. Nonetheless, I would keep half an eye on that just in case something more concrete is said about his policies, but I would imagine probably not, they'll wait for the inauguration to pass before adding that type of clarity. Okay, guys, going to leave it at that. Coming up to 9 o'clock this morning, looking out for that IEA oil market report. Okay, have a good session, and I will see you in the chat room. Thanks.